Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, we are diving into something that is absolutely vital if you care about your financial future. There are major changes coming to how credit reports and credit scores will work in 2026. And these changes are not just some minor tweaks. They will affect millions of Americans. This will affect how lenders view you, how your credit score is calculated, and what appears on your credit report, and ultimately, what interest rate that you may pay. This could also impact what homes you may qualify for and the opportunities that you may have in the future. We're going to walk through three major pillars of change, and at the end of the video, I'll give you some practical what this means for you steps. So without further ado, let's get right into the video. If you refer back to my other video like this at the beginning of the year, we talked about medical debt. Medical debt has been a heavyweight on millions of Americans' credit reports. Unlike credit card debt, people don't choose to get sick. They're often hit with unexpected bills that can total to thousands of dollars. Even with insurance, out-of-pocket costs and billing errors can lead to collections. And historically, these debts could stay on your credit report for up to 7 years, tanking your credit score and making it harder for you to get a mortgage, a car loan, or even just a credit card. But the key argument consumer advocates have made for years is that medical debt doesn't predict future financial responsibility the same way a traditional loan would. It's not a measure of recklessness, it's often a measure of unexpected events that you could not have accounted for. So let's rewind back to 2023. The three largest credit bureaus, Equifax, Experian, and TransUnion, they collectively agreed to remove all medical collections under $500 and any paid medical collections that were on your credit report. That change alone wiped out tens of billions in negative debt entries. Then, the Consumer Financial Protection Bureau, the CFPB, proposed going even further, eliminating most unpaid medical bills from credit reports entirely and banning lenders from using them in credit decisions. The Bureau estimated that roughly $49 billion in medical collections across 15 million Americans would disappear, with average credit scores increasing roughly 20 points for those who were affected. Now that sounds great, right? Well, here's where things get complicated, and that brings us back to what happened at the beginning of the year. I originally had reported this about the CFPB and how medical debts could be removed from your credit report. According to Newsweek and the New York Times, the CFPB's medical debt rule has run into some serious resistance. In late 2005, the CFPB issued new guidance that suggested the Fair Credit Reporting Act preempts state laws that try to ban the reporting of medical debt. So that means even states that pass their own protections could see those laws overwritten. At the same time, a federal judge in Texas vacated the CFPB's medical debt rule, ruling that the agency overstepped its authority under the FCRA. In other words, the future of this reform is now stuck in legal limbo. Some states may still enforce their own protections, but federal preemption could undermine those efforts. Meanwhile, the credit bureaus themselves are divided on how to proceed. They've already removed many medical debts voluntarily, but say further rules could limit their ability to verify debts accurately. So in short, the battle isn't over. It's shifting from policy to courtrooms and state houses. So let's discuss why this is important. Roughly 15 million Americans currently have medical debt listed on their credit report, and many more are affected indirectly when a spouse or a family member's credit takes a hit. Removing those entries could mean the difference between qualifying for a mortgage or being denied, or between having a 6% interest rate or maybe even one that's 7.75%. But if the CFPB rule stays vacated or federal law blocks state bans, many of those medical collections could actually return to credit reports in 2026. That would reverse years of progress and affect millions of borrowers once again. It's a high-stake game that will play out through 2026, and you need to be ready for either outcome. So if the reform does stand, your medical debt should no longer appear on your credit report or affect your score. But if the legal challenge wins, those debts may return and start hurting borrowers again. So the best move is to be proactive. Check your credit reports, dispute any inaccurate medical collections, and contact medical providers directly to negotiate resolutions before they escalate into collections. Even in the best case scenario, the CFPB's rule won't erase your debt, it just prevents it from being used against you in your credit scoring. You'll still owe the balance to the medical provider or collection agency, but it won't have the same credit impact. Just keep in mind, guys, that 2026 will be a make or break year for medical debt reporting. Whether it stays on your report or it comes back, it depends on how the courts and Congress respond to the CFPB's ruling. Either way, being proactive now by reviewing your report, disputing errors, and tracking state laws could mean the difference between lowering your interest rate or a denial on anything that you're applying for next year. Now, while medical debt dominates headlines, another quiet revolution is underway: how credit scores themselves are being calculated. Last year, I did a video on credit scoring models and all the different models to look out for. I'm going to link that video right here if you want to watch that. And one of the models that I talked about was the FICO 10T, and there's also the FICO 10B NPL. FICO announced that its newest models, FICO 10T and FICO 10B NPL, will use trended data to evaluate credit borrowers over time rather than just a snapshot. So instead of looking at how you manage debt right now, it will look at how your balances and payments change month to month over the past 24 months. And the BNPL version, short for Buy Now, Pay Later, adds those installments planned from services like Affirm, Klarna, and Afterpay into your credit data. So for the first time, your short-term split payments will be used in determining your credit score. Now, if you've been paying attention, this has been something in the headlines for a little while now. This could actually help you, but if you miss payments, then it could actually hurt you. Meanwhile, VantageScore 4.0, jointly created by Equifax, Experian, and TransUnion, is expanding the definition of creditworthiness by adding alternative data like rent, utilities, and phone payments. It also will use machine learning to evaluate credit trends for people with limited credit histories. So that means someone who has never owned a credit card but pays rent and bills on time can finally build credit without traditional loans. Now, according to the Federal Housing Finance Agency, the FHFA, both FICO 10T and Vantage 4.0 have been approved for use by Fannie Mae and Freddie Mac, meaning they will increasingly be used in mortgage underwriting starting in 2026. For borrowers, this means credit scores will become more dynamic. Your past patterns of behavior, whether you're improving or declining, will matter more than a single moment in time. So for the first time, someone who is actively paying down balances may actually be rewarded faster, while someone who's slowly building debt could see an early score drop even before missing a payment. In short, FICO and Vantage scores are getting smarter, but also they are far less forgiving. Now let's talk about the business side of this. I rarely ever see people talk about it, but 2026 won't just change your score, it could also change who calculates it. So FICO announced its direct licensing program, allowing lenders to buy credit scores straight from FICO instead of through the big three credit bureaus. This move cuts out the middleman and reduces costs for lenders by up to 50%. But it also means FICO is now competing head-to-head with the bureaus and their own Vantage scoring model. In response, Equifax and its partners slashed Vantage pricing and started offering discounted bundles to mortgage lenders for 2026. This competition could be great news for you as a borrower. More competition means lenders get scores cheaper and faster, potentially passing those savings to you through better loan terms. However, it also means you might see different lenders using different scoring models. Bank A might use FICO 10B NPL, while Bank B might use Vantage Score 4.0, so your credit score could differ by as much as 40 points depending on who's looking at it. That's why it's critical to ask which model your lender's using before you apply for anything. FICO is still the most widely used scoring model, with 90% of top lenders using it for credit decisions. However, Vantage is catching up and is becoming increasingly popular with significant growth in usage, and more lenders will be adopting it soon. Again, this was just a power play in order to make more money. Vantage cut their prices so they can offer this to mortgage lenders, and of course then FICO is going to make it direct to lender. That way they can cut their prices in half. So as you can see here, it's just a little back and forth between who's going to make the most money, and then for the consumer will be affected with all these different scoring models. So let's talk about what you can do right now. Right now, you should use annualcreditreport.com to download free copies from the three major credit bureaus. You want to look for any medical collections, especially those under $500, or disputed items that may be eligible for removal. You want to monitor alternative data if you pay rent, utilities, or use BNPL. Start tracking those payments through platforms that report to all three credit bureaus. Those positive records could boost with the new scoring model. You want to also ask lenders which model are they using. This lets you tailor your strategy. So for example, if you have a Vantage Score 4.0 that's actually really good, you know it favors rent data and it may even favor thin files, while FICO 10T favors stable trend behavior over time. You need to also stay ahead of medical debt changes. If the legal battle goes away, your debts may be removed. If not, you'll have to dispute them and make sure that you clean up your report in advance. These reforms bring hope, but also uncertainty. The CFPB's medical debt rule could still be tied up in court for months. FICO and Vantage rollouts may take longer than expected, and alternative data cuts both ways. Missed rent payments or utility payments can now hurt you just as on-time ones help. Bottom line, don't let the promise of change make you complacent. Good credit habits will always be important. You want to pay on time, keep balances low, avoid excess applications. You need to understand that still matters more than any new algorithm. And understand that these changes are happening due to 3 drivers: consumer fairness, medical debt is seen as unfair and non-predictive. Regulators want a system that will judge people based on financial behavior, not medical emergencies. Technology and data. The rise of BNPL and digital payments give FICO and Vantage a new universe to analyze, so they're modernizing their models to stay relevant. And then, of course, competition and cost. FICO's direct licensing and the Bureau's Vantage Score pricing war are reshaping how scores are sold to lenders, and that means faster innovation and lower cost. I want to thank you guys so much for watching this video. The rules are changing, but the fundamentals have not. You still have control over your financial story. You want to pay your bills on time, keep balances low, watch your credit report closely, and see if you have any medical debt errors or anything questionable. Don't wait. Take action, start disputing all this immediately, because in this new credit era, the people who stay informed and proactive will be the ones who win. So as we head into 2026, make sure your credit is something that you build and not something that's happening to you. If you found this breakdown helpful, make sure that you subscribe for more updates on credit, finance, and building wealth before these changes hit full force. I'll keep you ahead of the curve, and together we'll make sure that your money and your credit are working for you and not against you. Once again, thank you guys so much for watching this video, and you have a wonderful day.